Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So, like Bollinger Bands, acceleration bands are based on the principle of encompassing about 95% of the price action. For the techies out there, of course, that's saying 2 standard deviations. That 2 standard deviations is telling us that that's 95% of the time should stand between there. If we use 3 standard deviations, that would be 99% of the time. If we use 1 standard deviation, that'd be about 68% of the time. I find that 2 deviations is very good because if you think about it, if 95% of the time it's supposed to stay in between the bands, well, then guess what? I want to trade not the 95%, but the other 5% of the events occurring outside the bands. That doesn't mean I only trade 5% of the time, 1 out of 20 days. It just means that I rotate my capital among the different moves. You know, now with the ISE FX options, you've got literally a nice group of different vehicles the trends will change, and you can adapt and evolve from whether you're trading the AUX on the Aussie dollar against the U.S. dollar against the Aussie, compared to then moving on to the Canadian U.S. against Canadian, to the yuck U.S. against yen. Wherever the action is, it allows you to rotate on into that and move out of things that aren't accelerating outside of these. This idea really became crystal clear to me when I read a book called Soros on Soros. George Soros was interviewed, the famed hedge fund manager, and he said it was actually these unexpected events, and think about it, the markets are driven by the unexpected. If it's expected, it's already in the price of the underlying FX or any other vehicle, right? So the idea is it's the unexpected events we've got to really ride and stay with. And how many times have you looked at it on a trade where you say, I thought that this was only going to move so much, so I took this profit off at a small to mid-sized profit, and then you look and go, oh my goodness, look at how much money I left on the table. That in the traditional statistical terms, these are called the fat tails of the distribution, meaning that usually these are only supposed to happen about 5% of the time. More than 2 deviations outside of that, these tails should be thin. They're actually about 3 times fatter. In all of our studies that we've looked at, plus other experts in the industry who've looked at it, I've seen independent studies corroborate this, that they're happening about 15% of the time, these big surprise trends, more than 2 deviations, compared to what the model suggests. What does that mean? It means that there's a big opportunity for you when you get a trend started. And that's what Stephen always marvels at when we talk about stocks and FX options, in this case, that have made big moves, and you think, that just can't last, can it? But the reality is that trends in motion tend to stay in motion longer than people expect. Sure, eventually they're going to end. Our job is to show you how you can trade that and where you place your stop, so that if it does end, you're out. But if it gives you a nice low-risk entry point, you can actually get yourself back on board that trend rather than watching from the sidelines. So that's really, really critical, and will really allow you the ability to really manage your risk in that kind of a situation. So that's the first kind of piece of the puzzle. So an example of that is, and this is that call that I was telling you about that I made when Steve and I were doing this webinar back in 2007, is a case with the acceleration bands here in blue plotted against the Bollinger Bands, which are here in the kind of pinkish fuchsia colored line here. So what you see happening is that typically when this is the CDD, this is the U.S. dollar against the Canadian dollar. CDD is the symbol. This is actually pulled off a TradeStation. There's a number of different platforms you can use to pull this data. It's just I find that for the coding I do, along with a platform that's very Forex and FX options friendly, I've been very pleased with the TradeStation system. So basically, again, there's a lot of brokers that I like, so they're not the only one. But the bottom line is I've been using it since the early 90s, so I'm very comfortable with the coding language and all that. So what we're looking at here is that where is the breakout on the acceleration bands? The key breakout point for me when I look at this chart, is not just when we get 1 close above or below that band, but actually 2 closes outside that band. So in this case, this is back in mid-September. So you can see that happening here when we get not the first, but the second close. In comparison, you look back to the left a little bit and you say, well, it looks like it was trying to break out back there in mid-August, but it only had one close above and then it closed back below. So that's why I'll put an X marks the spot there, that was still not breaking out. It reversed and came back down into that band. So two closes outside that band tells me that we get that thrust, that power move, if you will. And so you can see in this case that, I'll draw a little highlighter on it so you can better see it. Let's make it kind of a yellow color, that basically we're then trending down pretty much below that band. You see that there's a couple of points. It looks like it comes back into that band, but I have some rules that will keep me on that as long as my trailing stops are not violated. You'll see more when we talk about percent R, how when it stays oversold like this, that's very bearish for the security, in this case, U.S. dollar being weak against Canadian dollar. What does that mean, remember? It means Canadian dollar is relatively strong, U.S. dollar was relatively weak in this period, and so there was the opportunity as it went from the mid 100, like about the 103 area on the sell area, all the way down. Even when Steve and I talked about this, it was in the upper 90s on its way down into the low 90s, down near the 90-91 area. So now where's it exit for us? We're going to talk about a couple different exit strategies, but based on the bands approach, it was actually the official bands exit was happening right back here as it broke above that 20-day average, which is that thinner blue line there. But we're going to show you an even faster way with the percent R, that once a percent R gives us that retest, that will actually get us out earlier, which you can see happens back in this area. So these are building blocks. I'm literally trying to create a foundation for you to understand how we adapt. And you can see what also happened after that. You can't get stuck in a bearish view, because once you then break out above those bands and you get two closes in a row above there, you can see that happening right back in here about the 98 area. Well, we go quickly from 98 up to 101 just over the next week and a half as we get that nice little acceleration to the upside above the upper band once we get two closes outside of that upper blue band. Now, you notice also I've shown you the Bollinger Bands on here just so you can get a feel for the difference between Bollinger Bands and acceleration bands. Bollinger Bands will typically race to catch up. So what you're seeing happening here, as I undo a couple of those for a second here, is you can see that the Bollingers are staying, well outside of these bands here. And the idea there is that we're really looking at a situation here in which, look at how the Bollingers are, staying outside of there. Meaning, to me, that's a sign of a more volatile market when the Bollingers are staying outside of the acceleration bands. In comparison, of course, when we had the situation like back here in as you look at it back here in this window, let's draw a couple of support and resistance lines. You can see how things are kind of contracting right in this zone back here in August and early September, that you're stuck in between, the Bollingers stuck inside of the accelerations. That's more emblematic of a trading range in a given security. I tend to stay away from those. You could try to play the time decay game and bet that it's just going to go relatively flat, but the problem is once it breaks, and you got that break, of course, happening here in mid-September, you've got to unwind any kind of a bet that you had that it wasn't going to drop, because now it's giving you a signal that it's got more problems in the future. So we've seen so many of these that have happened in the course of course, not only the stock market decline September and October of 08. Remember, this chart's back in 07, but bottom line is also the what you're seeing on the currencies on both the upside and the downside. Let's look also at reinforcing now, as I alluded to percent R. Let's just give you a little bit of the basis for what I'm talking about with percent R here as well.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.